Welcome back to Prosperity Foundry, where we forge the path to financial freedom together. Today, we're diving into a topic that's often misunderstood, yet crucial for your financial well-being: credit. Understanding credit can feel like unraveling a mystery, but by the end of this video, you'll have a solid grasp of what credit is, how it works, and why it matters. So let's start with the basics. What exactly is credit? In simple terms, credit is the ability to borrow money or access goods and services with the understanding that you'll pay later. It's a tool that can help you manage your finances, but like any tool, it needs to be used responsibly. Now, why is credit important? Well, having good credit can open doors to better interest rates on loans, mortgages, and even impact your ability to rent an apartment or get a job. It's like your financial reputation, reflecting how trustworthy you are when it comes to repaying debts. Let's talk about credit scores. Your credit score is a three-digit number that represents your credit worthiness. It ranges from 300 to 850, with higher scores indicating better credit. This score is calculated based on several factors: payment history, amounts owed, length of credit history, new credit, and types of credit used. Payment history is the most significant factor, making up about 35% of your score, so always aim to pay your bills on time. Late payments can have a substantial negative impact. Next, we have amounts owed, which accounts for 30% of your score. This is where the concept of credit utilization comes in. It's the ratio of your current credit card balances to your total credit limit. Keeping this ratio below 30% is generally recommended to maintain a healthy score. Then there's the length of your credit history, which makes up 15% of your score. The longer you have credit accounts open and in good standing, the better it is for your score. New credit and types of credit used each account for 10% of your score. Opening too many new accounts in a short period can be seen as risky behavior, and having a mix of credit types, like a credit card and a car loan, can positively impact your score. Now, you might be wondering, how can you check your credit score? There are several ways to do this. Many banks offer free credit score monitoring for their customers. There are also free online services that provide access to your score. It's a good idea to check your credit report at least once a year to ensure everything is accurate. Let's shift gears and talk about building and maintaining good credit. If you're just starting, consider a secured credit card. This type of card requires a cash deposit, which acts as your credit limit. It's a great way to build credit without the risk of overspending. Another tip is to become an authorized user on someone else's credit card. This can help you build credit, especially if the primary cardholder has a strong credit history. But remember, any negative activity on the card can also impact your credit. For those of you already using credit, be mindful of how often you apply for new credit. Each application can result in a hard inquiry on your credit report, which can temporarily lower your score. Instead, focus on using your existing credit responsibly. Now let's address a common misconception: carrying a balance on your credit card. Some people believe that keeping a balance improves your credit score, but that's not true. Paying off your balance in full each month is the best way to avoid interest charges and build a positive credit history. As we wrap up, remember that credit is a powerful tool. Used wisely, it can enhance your financial journey, but misused, it can lead to debt and financial stress. So educate yourself, stay informed, and make responsible choices. Thank you for joining me on this exploration of credit. If you found this video helpful, don't forget to like, subscribe, and share it with others who might benefit. And as always, if you have questions or topics you'd like me to cover, drop them in the comments below. Until next time, stay financially savvy.